Morning, everyone. This is Anthony, Wall Street Trader. It is 11:35 a.m. Eastern Standard Time on January 14th, 2023. We're going to go bold and we're going to go old. We're going to talk about gold. Okay, this is not financial advice, it's educational. Click the subscribe and the bell, share the video, click the thumbs up. Intraday updates on Twitter at Wall Street Tra 12. Okay, before we get into all of that, if you guys have any cryptos or stocks you want covered on this next video or on the next video or on one of the subsequent videos, just add a comment below the video with what it is you want covered. Be happy to do so. In the meantime, before we get into the gold charts, give brief background on gold. Gold has recently surged to an 8-month high. It's around 1920 right now an ounce, up around 25% or so over the last few months. And if you look at demand versus supply, the demand last year in Q3 was 28% higher than the year before. In fact, supply marginally, I mean, I would consider it flat. It's up 1% on supply. So demand is clearly outpacing the supply of gold, and that's a big part of why we see more recent price action in gold. Additionally, you're starting to see a lot of central banks step in here and accumulate gold. In fact, they bought nearly 400 tons of gold with quarterly record for that in terms of central bank purchases. Let's go over to drivers of gold. The big events that help gold. Dollar going down helps gold. So recently we're starting to see the dollar under pressure. We'll go through that chart later. But the price of gold is generally inversely related to it because gold is dollar denominated. Also, we're starting to look at past charts all the way back to the early 70s. Major inflation spikes we've seen time and time again have increased gold buying. In fact, stagflation, which is an aspect of inflation, it's a part of the cycle where you just have inflation for quite some time. And we're seeing that right now. In fact, you'll see stagflation occur also in the past, in the early 70s, where we've seen that happen as well, and that helps propel gold pricing. So let's look at the last point here, which is around Fed. The Federal Reserve Bank, which is our central bank here in the U.S., they don't seem to be taking rate increases too seriously. Rate increases were meant to help slow the economy down, meaning you slow the economy down by raising interest rates. It makes the mortgage rates go higher, auto loan rates go higher, corporations can't borrow money at a cheaper rate. So it makes everything harder and puts a lot of pressure on the system to decrease demand, which kind of screws up the economy. So it also, so the Fed doesn't necessarily want to crush the economy. One way to not crush the economy is to not raise rates so much. But if you don't raise rates so much, you're kind of in a situation where you're making the inflation worse because you're not attacking it. So I'm starting to look at some charts here. We're going to go into that and let's go straight into it. But before that, central banks, a quick view here. Central banks 300% year over year change from Q3 of 21 to Q3 of 22. Look at that number. I'd love to know why central banks are accumulating so much. And I have a feeling it has to do with their drive to get off the dollar standard. Using more gold, physical gold, is what these purchases represent. In the meantime, we're going to go straight into the market. Looking at gold here, this is not in terms of the long-term view. Gold is really kind of doing well over this trend line and bouncing up. Now let's just look over at the CPI because I think that's important for everyone to see. Back in the early 70s, we had this massive stagflation period. In fact, it was inflation period. As you can see, year over year inflation was minus 50%. That means inflation went down by 50% year over year back in the early 70s, in 72. After that, inflation wound up almost doubling, more than that, about up 165% year over year inflation growth. That's a huge jump. We see the same thing back here in 78. We saw a massive inflation jump from year over year inflation to 32% all the way up to 148%. Now look at these two. Based on these shaded areas, prices of gold went up 182% for the first leg of massive inflation spikes. Second phase of this yielded 262% increase in gold prices. and it's reflected over here in terms of the gold chart. So if you look at the gold chart here, and we just have a peek, these are the same periods on the gold chart. So as you can see, massive spikes, massive spikes. Now we haven't seen a spike yet over here. This is coming from right around the period where we had the coronavirus kicking off in March, when we started to see close to zero rates on the 10-year Treasury. It was pretty bad, and now we've really blossomed up. So as you can see, we were year over year at minus 92%. And then we went all the way up as high as 64% year over year. It's coming down a little bit, but I think this is a blip on the screen. I think eventually we're going to start to see this thing either level off or start kicking back up again. In the meantime, let's go over to the dollar so that you can see what's going on here. The dollar clearly on this upward channel since 2011. We really saw, and the reason why gold wasn't doing so well in 21 and early 22 is because the dollar was just coming up and up and up and up and up. Well, it tagged this resistance area up here and is now starting to trek back. I have a feeling we're going to come all the way back down to around 95 on the DXY. This is the dollar currency index, which is relative strength of the US dollar to many other big currencies out there. In the meantime, I think gold, in terms of its target price, I'm looking at a 2600 level. So if we could zoom in for the let's zoom into the 5-year chart here, and then squish this down a bit. I think we've got some more wood to chop. It really hasn't proven itself in terms of prior periods yet, but I have a feeling, just given the fact that we've got, dual convergence of support here, it's almost like a magnetic action. I think we could get up to around 2500. If you zoom out all the way to the end of the year on this chart, we're looking at probably 26, somewhere between 26 and 2700. Some gold experts out there are calling for 2900. I kind of like call it as I see it, and that's what I'm looking at right now. But in the meantime, Dixie going down, I think we'll continue to rock it down over the next several months. I think gold has definitely kind of it's coiling up, and it's been coiling up for quite some time. I think we're ready to take off this year. I think so. My end of year price prediction for gold is around 26, 2700 range. Anyway, hope that was helpful to everyone. Have a good day.